Hello traders, Nick Shaheen here looking at Nvidia, and the point of this video is not to recommend trades or anything. In fact, nothing in here is a trade recommendation. I'm just sharing what happened to my account yesterday and today and how I handled it. The point is to illustrate how I would deal with a credit put spread, also called a bull put spread. It's an options trade that's bullish that went under fire. So Nvidia, everybody loved it not too long ago. I have not listened to CNBC all year, not 1 minute. That is my New Year's resolution, and I'm such a happier person doing so. Why did I stop? Because they told me to. I reached out to one of them, whatever the hell his name is, the judge, Wapner, and funny, Judge Wapner. He said stop watching. So I acknowledged that. Okay, I will. So back to Nvidia and what happened. So the credit put spread is a bullish position where I sell risk in a place where I think the stock is not going to go. Unfortunately for me, when I sold it, the stock was somewhere here. I don't remember exactly when I opened it. The bottom line is I collected $1, and then by the end of yesterday, which it collapsed 7% yesterday. Today is the 9th March, and yesterday is bad for all. The Nasdaq fell like 3%, maybe 2.8. So everything got hit hard almost. And Nvidia fell 7%. So at the depth of the day, I looked at Nvidia, I looked at the chart, I did my logic, and then because I know how to read charts, I decided to, you know what, I don't do that often, and I doubled down. So what happened, I sold the same spread I sold before, and before I collected $1 on a $5 wide spread. I'll show you what that means. And then yesterday I collected $2.50, $2.55. So the blended price today, it gets me back to even, and now I can close the trade for even. So here is what it will look. First of all, why did I double down? I don't always double down, but I did homework on the charts, and Nvidia lost its leg right here, and the downfall from that, the target measured move, so to speak, from that should be lower. But then I looked left, and I found 2 or 3 great stopping points, support zones. So I said, I don't think it's going there. It just took a 25% haircut, and the bears think they've got control of everything. But then I looked at the SPY, and then this is not a bearish chart. The bears, all they got going for them is this little stint of lower highs, and today it's under fire. So that's happened before, twice. So this is nothing new. And I ghosted the last time it happened. We had a bigger breakout, and this is unfolding almost tick for tick as the last correction. So macro says the world's not falling apart. The media might be covering it that way. I don't know, since I'm not watching, but I'm looking at my own things, and I don't see evidence of the bears have control over the long term. They don't. It's not in the charts yet. So back to Nvidia. Nvidia is not going to fall on its own. It just took a 25% haircut. The S&P is still within 3% of its all-time high. Screw that. I'm catching this falling knife. So I did. I doubled down. Here's what the trade looks like. This is going to be a little lesson about how to do a credit spread. What is a spread, first of all? This is a credit spread. This is Nvidia. This is April. Contract has 38 days on it. This is current price, somewhere around 500. Today it's up a bazillion percent, 8%. Yesterday it was down 7. Today it's up 8. What is this, GME? So to open this spread, it now is $1.85. Earlier it was $1.75. When I opened it yesterday, it was $2.50 or $2.55. I can't remember. To collect credits. See? Credits. So that's why it's called bull put spread, credit put spread. It's bullish because it wins if price stays above 480. Or at 480, or slightly below 480, I still win. And the thing is, it's bullish, but it does not need a rally to win. All it needs is nothing. It needs just not time to tick away. The Wall Street jargon for this is theta burn. Don't know why they insist on calling it theta. It's freaking time. It's time. Why stick a theta in there? Just to sound fancy and intimidate everybody off of Wall Street. Screw that. So I sell the 480, that opens risk. I collect $1,900 for one contract. You know what? I don't want to own shares, so I buy the 475 below it. That limits my risk, and now I have to give back $1,700 of my $1,900. Net, I collect $1.85, which means it's $180 to open one contract. So the trade would look like this. $180 going credit I received today. No money leaves my account and I'm long Nvidia. Zero money leaves my account. This is not a trade recommendation. I'm illustrating the point of what happened. And now my risk is the balance, 322. Now you're thinking, oh my gosh, 320. I'm risking 320 to make $1.80 or whatever. Yes, that's a 50% reward with pretty decent odds. So it's a pretty aggressive trade. I don't care how you word it. It's a calculated risk. In my calculation, I'm giving myself this much edge. This much edge. The stock can fall this much and I'll still be okay. But that's not, I don't just look here. I looked, we started by saying looking here. So 480 is right there and it just fell 25%. So I'm catching the falling knife with kid gloves. I don't need a rally. If it comes, great. All I need is time to tick and it being bottomed. That's it. In fact, I could have closed the trade today and made money off of the batch from yesterday, or closed the whole thing and gotten even. So Nvidia is a good long-term hold. It will follow markets. It won't rally alone. It won't fall alone. Is this a good starting point for Nvidia? Yes, if the markets rebounds or stabilizes. I prefer AMD because it's cheaper. And if you don't believe me, I'll show you in a minute. But the point of this video is already made. Credit put spreads, bull put spreads are easier ways to catch falling knives than to buy upside hope. So the alternative to buying this is buying shares, which is totally viable. Time is not a factor. You just buy them and you sit on them. Everybody knows how to do that. A lot of people dabble in options, and what they do is they buy calls. Well, the calls are, one call for 38 days is $2,600. That's a lot of money. So I would do myself a favor. So you think, oh yeah, but look, they doubled their money. Yep. But if you guess wrong one day, you lose half your money. Look at these guys. Somebody who shorted Nvidia yesterday bought puts. They lost half their money. So they lost $2,000 on one contract right here. Look, it dropped $2,000. One contract is 100 shares, so it's 1985 times 100. So how do I mitigate this drop of 40%? If I'm buying naked calls, I'd buy them in the money. I pay more, but they lose less fast. If we get a drop, they would have lost on a bad drop like 15% versus 40%. But the easiest way is to make a debit call spread. So I would buy a call, I would sell a call. If I make it $10 wide, so here I would be spending $3 to make $7. And what I need, that's the difference. I need a rally. I need a rally to 535 or more for me to make money. The other one does not need a rally. The other one needs nothing except time to tick, and then it's a winner. So 480 and 475. Boom. There it is. Sell this to be long or buy this to be long. Do both, and you're spending $1.40 instead of $3 to be long, really long Nvidia. So now if you get a rally, you only paid $1.40 for something that would have cost you $3. If you get a drop, now you have new risk down here. If nothing happens, you risk $1.40, not $3. So this is a combined way of being really long. This is long, this is long. Doing both is really long. Usually I start with one, and if it drops, I do the other. And if it doesn't work, then I'm out even Steven. All right, so I said that, should I do that? That's going to piss off some people. All right, I'll do that. So here we go. Nice sales line up, profit margins down, not good. Debt to assets ratios are up, meaning the debt is building faster than the assets, easily said. Not disastrous, still a growth company. They're still well positioned for the future. I'm just evaluating it, right? PE is 67, that's pretty high. I don't care. But what I do care about is that AMD now's PE is in the 30s. It used to be 3 digits. It was 250 at one point. It was 150 at one point last year and 2 years ago. And then now it's in the 30s. More importantly is this line. That's what I care about. Price to sales. for growth companies. 17. Let's round up to 18 for easy math. That is a lot. That means when I buy the shares, I'm giving it 18 years worth of full year sales credits in me buying into it. You say, well, it's going to grow into it. Yes, but I'm comparing it to AMD, and AMD's is 9, only 9, and it grows just as fast. In fact, AMD's debt to ratio is dropping, debt to assets, which is good, and the profit margins are rising. If you don't believe me, I'm not making this stuff up. You can have your argument with TradingView, which is the software we're using right here. There we go. All right. Also growing the top line, the blue bars. The orange line, profit margins. The orange line here is debt to assets. Down is good. The debt is the numerator. The assets is the denominator. If that thing is shrinking, it means the denominator is growing in size relative to the numerator. And assets are up, and away. So Lisa Su is doing an awesome job from that perspective. Look, 9 and 36. 151 PE, 40, 30. So this is almost Apple. Apple is like 32 and 7. So just to give you a flat comparison, and Apple doesn't grow nearly as fast as this one. Oh my gosh, what did he say? Yes, I said it. You can go check it out. All right, Nick signing out.